The Bank of Canada is saying 13% of mortgages have hit their trigger rate. So what on earth does this mean? What we know so far is the Bank of Nova Scotia and National Bank are passing on these higher rates directly to their consumers. But other banks such as the Royal Bank, CIBC, Bank of Montreal, and TD are letting their customers basically not pay their principal. They're allowing their customers to essentially default on their mortgage without calling it a default, by letting them roll the money that they're not paying into their existing loan, making them go further into debt, possibly putting them upside down on their mortgage, creating a bigger crisis event for the future. Now, a lot of you are probably wondering what I'm talking about when I say trigger rate. Essentially, the trigger rate is a threshold when interest rates get up to that point. The mortgage rate resets on a fixed variable payment mortgage. Now, I know that sounds like contradictory things. Fixed payment variable rate. It doesn't even make sense. But essentially what a fixed payment variable rate mortgage is it's where your payment is fixed. So your payment remains the same, but the rate in which your mortgage is based on is variable. So that means when rates go up, you pay less and less towards your principal and more towards your interest. And this piece of financial engineering was so popular during 2021. I know what you're thinking. You're thinking this sounds ridiculous, and it really is ridiculous, but lots of people piled into these mortgages in 2021 with all the fear of missing out and just the insane mania that we had. People were just desperate to get into any product that they could possibly get into. And guess what? The banks, they were happy to accept people into these fixed variable rate payment mortgages. If we look back to what happened in 2008, you can see that there are similar things that are probably likely to occur during this crisis too. For example, a lot of people pin it on subprime for the reason of the collapse, but really it wasn't. The collapse was actually due to the recession that happened. I mean, think about it. If the economy hadn't have slowed down, people would have been able to continue making their payments and everything would have been okay. But the problem was when people started to lose their jobs, they started to default, and then the foreclosures started, and that really started to cascade down on the banking system over 2008 and 2009. Default rates in the peak of the financial crisis for prime borrowers were around 11 to 12%. And prime borrowers, according to the NBER report that came out in 2015, were actually the ones that attributed the most towards the foreclosures that happened during the global financial crisis. You see, everybody would be led to believe that it was subprime that caused the financial crisis. But studies have been done, like this one, which I've linked below, that show that that's not the case. And it's probably going to be the same case in Canada too, where it's going to be your prime borrowers, your borrowers with good credit ratings that are going to get hit and are going to end up in foreclosure, just like what happened in the US during the global financial crisis. And now I want to read you out a quote of what the financial regulatory body says here in Canada about this situation. OFSI has not set a specific amortization cap for financial institutions allowing negative amortization, said Carol Sandin, a spokesperson. However, we do expect actions to remain within the bank's risk appetite. So essentially what she's saying there is that the banks are taking on extra risk by pushing these amortizations out, by letting people get further into debt, by letting people essentially default, not pay their mortgage, but that money that they're not paying is rolled into their loan at today's interest rates, and people don't realize or know how much debt they're really getting into and what's really happening on the back end. The problem then becomes when you head into a recession and all those people are put out of work, and basically then they go to sell their house and realize that they are totally upside down on their loan. They owe more than the house is worth. And that's just if housing prices fall 10 or 20% from the peak in 2021. We've already had many markets in Ontario pass that and go beyond 20% in nominal terms. So this is really just the first leg down. And if you look at any chart that shows you the phases of a bubble, you can clearly see that we are in the denial phase. And during that denial phase, you can have housing prices stagnate, they can even rise a little bit, but you're not going to see capitulation until you get to a point where the unemployment rate goes up, people start defaulting, and then there becomes all these sellers that are forced onto the market and they have to sell. They can't just sit back and say, I'm not getting the price I want, I'm not getting the price my neighbor got, so I'm going to hold off and wait until next spring, exactly like we've got right now. You see, the recency bias is such a powerful thing because for the past 10, 20 years in Canada, housing prices have pretty much just gone up in a straight line. So people just think that they can hold off and housing prices will continue to go up. But when you do the math on the rate that housing prices have appreciated in Canada, you realize very quickly that that rate cannot be sustained. The amount of credit, the amount of money that it would take to sustain that rate of appreciation just wouldn't be possible within any economy, let alone Canada, which is destroying its natural resource sector and relying more and more on the credit bubble that it created. I'm just going to throw up this chart which shows Canada's housing dependence. This chart comes from Bloomberg, and it just shows you, compared to other countries, how Canada has just become dependent on this real estate bubble, dependent on the credit expanding and expanding and expanding. And the people that are allowing their clients to slip into negative amortizations to add more and more money to their balance, these are the same folks that bought you the RRSP loan so you could leverage your stock and bond portfolio to buy real estate, and also let you use your house as a cash machine via the home equity line of credit. People going further and further into debt just is not a good thing, and people aren't even paying their principal down. In fact, the amount they owe is getting larger and larger and larger, and they probably don't even realize it. The thing is, people don't check the terms of their mortgage. They don't understand truly what they've signed up for. And it's only now that we're starting to realize these things. I mean, think about people who took out these fixed payment, variable rate mortgages. What did they think when they took them out? Did they know about the trigger rate? No, they probably didn't. They're probably only just finding that out right now. And the banks, they knew all along that that was going to happen. And you didn't know. And that was how they wanted it to go. The thing is, the banks aren't going to hesitate to take people's houses. They aren't going to hesitate to foreclose on people's homes. And it will happen. The thing is, the economy is in the most precarious place it's ever been in. When you look at the yield curve, it's the most inverted it's ever been since the 1980s. And during that time in the 1980s, half of all Canadian financial institutions that have ever gone bust went bust in the period from 1987 to 1996. So what does that tell us about the period of time that we're heading into now in 2023? It does not look good. If you've enjoyed this video, you might like that one there, and you might also like that one there that the YouTube algorithm recommends. I will see you guys in the next video. Thank you so much for watching. Sign up for my free email list in the description, and I'll see you next time.